Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Ducina, Matt Mondu, and Dan Cedar, and I missed the memo on Purple Jackets today, so sorry to the audience for that. I'll give a quick market update before we jump into our formal topic for the day, which is making the most out of your relationship with your wealth manager in the first quarter of 2025. So we'll dive into that momentarily, but as we look at markets to start the year in 2025, fair amount of volatility. I think more recently what that's been driven by, we're in this good news is bad news cycle. We got a very hot jobs print in the US to start the year. So December jobs came in much stronger than expected, and that led to an uptick in US Treasury yields. And again, good news is bad news. The stock market is not liking that. You've got this fallback into the usual scenario where rates up, stocks down. So as we get into earnings season, I think that's going to be a continuing trend to watch. But over the next few weeks, and as we get through the next month, call it into February, stock-specific, company-specific updates are going to start to matter a lot more.
And hey, Daniel, just to take a quick pause, because I think that can be a confusing topic for people. Like when we talk about good news is bad news is good news. Like let's maybe just unpack that a little bit and talk about kind of what's driving that, why when rates are up, like what's the expectation there, what's the market digesting, and why is that ultimately bad for stocks?
Yeah. So if you step back and look, okay, more jobs being added in the US economy, that's technically a good thing, right?
These are counterintuitive concepts, and that's why this is helpful to explain, because these things are like fly in the face of conventional wisdom.
Technically a good thing. But things like better wage growth, that can be perceived as something that might stoke inflation. The knock-on effect of all this is that it is likely going to prompt the Federal Reserve to cut interest rates less than originally expected in 2025. Higher interest rates can represent more of a hurdle for companies from a profitability standpoint. And also, if you want to get into the weeds, what an investors would value a business at because of the mechanism that they're using to discount cash flows. So a higher interest rate generally can cause some pressure in the equity markets. Thus, anything that can be perceived as good growth economically could be perceived as bad news for stocks, which is basically what we're seeing right now.
So the Fed views it, if the economy can sustain itself at a higher interest rate level, there would be no need to cut. They want to save those cuts for a period of time when the economy starts to falter, or there's cracks in the economy. The cutting of interest rates ends up being stimulative, so it'll stimulate the economy when the economy starts to struggle. No need to stimulate an economy if the economy's cooking and doing well.
That's exactly right, because the Fed was focused on the inflation part of their dual mandate for so long. In the middle parts of last year, they turned that focus more concretely to the labor side of their dual mandate. In the last few months, the messaging that has come out of the Federal Reserve is more focused on not stimulating and overstimulating the economy by cutting interest rates because of the fear that that would stoke a reacceleration of inflation.
Yeah, and more dry powder for the Fed too in the event of a really catastrophic event. When rates were at zero, if you remember the zero interest rate policy back in the day, the Fed had to really go to extreme measures in order to create easing in the system. So when rates are higher, it gives them more dry powder for a rainy day if something were to occur down the road.
Correct.
So they're not overly inclined. They want to hold that ace in their back pocket.
Correct.
Right. It's amazing. It all comes back to the Fed. But at the end of the day, I just think that's a really crucial thing for investors to understand, because they don't teach you that in school. That's not economics 101. This is something a little different when we see the application in the real world.
Right. Okay. So making the most out of your relationship with your wealth manager in the first quarter of 2025. We can go a number of different directions with this conversation.
We will go a number of different directions.
We will.
Yeah,
and
lots
we will
to talk about.
We will try to keep this under 90 minutes. But realistically, you guys tell me what the best place to start is. I mean, we could talk about portfolio construction. We could talk about tax front. really we can go whatever direction we want to start, and we'll kind of follow along from there.
Matt, we just finished year end. So why don't you give us an overview of what went down at year end as part of tax planning and how that is impacted in the first month or 6 weeks of the first quarter?
Yeah, great question. So number one, something we're doing as advisors at the end of the year is tax loss harvesting. So there's always, not always, but some of the time there's a handful of positions, depending on when an investor entered the position, initiated that position, that they may have a temporary loss in the stock. So the stock just moved against us in the short run. It's our job in a taxable account to take advantage of that loss. And that's, common. We've talked about this before, tax loss harvesting. This is like the routine maintenance that needs to exist at year end to manage a portfolio in a way that provides the most tax advantage for the client.
So tax loss harvesting is when you say harvest loss, you sell the position that's at a loss, you recognize that capital loss, and that capital loss can be used to offset directly capital gains. Dollar for dollar can offset gains, but if the investor results in a net loss, up to $3,000 of that net loss can be used to offset income. And then on top of that, anything above and beyond the $3,000 can be rolled forward in future years. Those losses do not expire. So the losses that you harvested in 2024 can actually go towards offsetting gains in 25. And just to be clear, because I think this can be confusing, this technique is from an accounting perspective only. So you could have a client or a portfolio or an investor who's had a wildly successful year in their portfolio. Their portfolio is up from a total return perspective, but from a tax management perspective, we're still able to book losses and show from an accounting perspective a taxable loss. Yeah, and I would say, and Daniel, maybe you can chime in here too, it's one of the advantages of running a stock model, right? We have more flexibility within the underlying, investments within a portfolio to kind of pick and choose when the opportunities present themselves to create some tax alpha, to create some tax advantage for clients. And you don't always get that case when you're just in the market.
Yeah, well, and it's certainly different than basically just being dealt a hand at the end of the year, like the experiences with mutual funds, where you may or may not get kicked a capital gains distribution. I would say it's important to monitor this type of activity throughout the year, right? So obviously you're going to see elevated tax loss harvesting activity as you get close to the end of the year, because you don't want to be sitting on any losses as the calendar year turns over. We do this on a monthly basis where we're scanning for any opportunities, but the activity picks up at the end of the year just to again, make sure you're getting the most tax alpha possible. The knock-on impact, and I guess the expectation, or as you look at the first quarter of 2025, what you might see in terms of your relationship with the wealth manager that you work with, those trades more likely than not will be reversed in some capacity. For example, we wanted to wait to reverse some trades we did even as far back as October, November in harvesting losses, because you don't really want to recognize short-term capital gains as you round out a year, because there's just less time for you to offset those recognized gains with losses. So I think that certainly it's prevalent for us, and I would say anyone that is working with a wealth management provider expect to see some of those types of trades, right? And while we don't operate in I think the wealth management community overall tends to be very calendar driven with regards to rebalancing and portfolio allocations. Maybe I'm wrong, but we operate in a way that is, quite frankly, not necessarily calendar inclined. I mean, certainly at the end of the year with the loss harvesting stuff, that's obvious, but otherwise, I mean, we make changes to allocations when the market or specific securities would dictate or necessitate a move. Mm-hmm. Whereas I do think that in the first quarter, January specifically, you tend to see more wholesale changes across the wealth management space at the start of a year. And I think that's another kind of what to expect. Expect some dialogue from your wealth management partners in terms of outlook, expectations for the market and resultant portfolio activity.
Is my asset allocation appropriate? Do I have the right securities, or whether it's stocks or bonds inside the portfolio? And the back half of tax loss harvesting, and I'm going to toggle between these two concepts. Matt teed up selling positions at a loss at year end. Well, you reverse that trade in late January or early February to get back into the position that you initially sold if you still like it. So when you sell the temporary position that you're holding for 30 or 40 days, and you have to make a decision to reinvest back in the portfolio, do you go back into what you owned before? It's a great time to look at rebalancing, making sure that the overall portfolio is properly positioned.
Yeah. What else on the tax front? So we've talked about tax loss harvesting in the past, and we've kind of outlined, I guess, the general year-end proceedings on this podcast, but what other tax considerations should individuals expect in terms of interactions with their wealth management firms in the first quarter of a new year?
So I think of one too, and this kind of goes to the other side of tax, right? So a lot of times people who are retired might be taking distributions from a portfolio. They might be in need of raising cash so that we can meet 6 months, 12 months of distributions. A lot of times we're going to put that off and not do that in December. Again, in the spirit of delaying the tax, delaying the payment of tax. If we can push a trade out that could occur December 1, generate a bunch of tax, to January 1, we flip the calendar on a new tax year. And I think there's a lot of value in that for clients, because then we have a year to offset those gains potentially.
Yeah.
So always looking at strategies to either defer tax, minimize tax, or perhaps eliminate tax altogether.
Yeah, this isn't a tax strategy, but if you're making those types of adjustments to the portfolio, let's say you're a nervous Nelly, or you're scared that the markets are going to pull back, or you're bearish on the overall environment, you could raise cash in the form of 6 to 12 to 18 months of cash just as a reserve. Because bear markets generally are short in nature, they don't last years or decades. Historically, they haven't, at least. What that does is it gives you the ability to raise some cash. And if the markets gyrate, you can focus on the long-term strategy, knowing that you have 12 to 18 months in cash in your back pocket as a reserve. So I guess that goes along with raising some cash.
Yeah, I mean, other things we think about is, it's that time of the year to if you're eligible to do a Roth contribution, Roth IRA, a pre-tax IRA contribution, or backdoor Roths.
Okay, and contributions can be made for Roth or for IRAs up until tax time for the prior tax year. So meaning you have until April 15th to make an IRA contribution in 2025 for calendar year 2024.
Exactly. So those things are occurring. I mean, the other tax considerations, sometimes, we're getting 1099s produced, or the different tax forms from your custodian. Those are starting to come out. Generally, that takes a couple weeks into the new year, but those forms start to become available. So getting those to clients or CPAs so they're prepared to file their taxes.
Yeah, which is, I think, an easy task for us now. So as Blue Chip has gone down the path of launching tax, we now have Blue Chip Tax. It's easy for us to take client 1099s, walk down the hall and hand them over to Al, or to answer questions for Al with regards to the client's tax environment. But if you're not working with Blue Chip Partners, or you're not working with our tax department, make sure that your wealth manager is coordinating with your CPA for seamless delivery of tax documents in the form of 1099 or any other type of tax document you might receive.
Well, and that's like the other kind of making the most of your relationship in the first quarter with regards to your relationship with a wealth management provider. You have to engage, right? Like, I think that engaging in the first quarter, I mean, it can be especially important because when you think about the potential for tax implications that may have changed year over year, if your taxable income has increased over the last calendar year or tax calendar year to a point where you've just changed brackets or something of the sort, I mean, not only does that have implications for your actual filing of taxes, but it also has implications for how your wealth manager may invest, right? We spend a lot of time, I guess, getting into the weeds of, for example, in fixed income, where in municipal bonds, it used to be beneficial technically for anyone in any tax bracket to have some exposure to that tax sheltered income that municipal bonds can provide. Today, depending on the securities you're using, we kind of estimate the 32% federal bracket as kind of being the hurdle rate to overcome in order to have actual benefit from municipal bonds. So the reason I say it's important to engage, that's just one example of how important it can be, because those changes could potentially impact what we would view as your most desirable investment allocation.
That's a great point. One last thing that might relate to tax. We don't have to end on tax, but the management of taxes is very much seasonal in that you file your tax return in April and everybody thinks about the time period between February, call it February and April. They're receiving tax documents. They go to their CPA. The CPA prepares and files the return. But tax management is a process that is iterative. It goes on throughout the course of the year. We mentioned at the beginning of this discussion tax loss harvesting, which we do at year end. Another year end item that tends to be year end, but really you should be thinking about it all year long, is charitable bequests. So if you're charitably inclined and you give to charities, there's often very strategic ways to give to charities through your retirement account. And there's a lot of criteria that we talked about on a previous podcast. But if you're over the age of 70 and a half, you have an IRA and you're charitably inclined, there's something called a QCD, a Qualified Charitable Distribution, that you can make from your IRA and bypass any tax payments that would otherwise go to the government. So I love that strategy. And I bring that up now in January because people should be thinking about these strategies, not just on December 15th as the year end is coming to a close. They should be thinking about these techniques throughout the course of the year. The word is planning. It's not plan one time, make one plan, and then it's done. It's planning. It's a process. We're advisors. We meet with people on a regular, ongoing basis to consult, to oversee their circumstances. And so these types of advisory recommendations are items that we're looking at all throughout the course of the year.
Yeah, and I think too, somebody made the comment a little bit earlier, like make sure you're getting credit for what you did in the year. So
is that rule number two? My rule number two, Matt?
Rule number two, but a lot of times there could be instances where CPAs don't fully understand. If blue chip, we have blue chip tax here when things are in house, it's super easy, but that's not always the case. And sometimes a CPA could take for granted a strategy that we employed and it not be adequately represented on a tax return. That can happen with backdoor Ross. I could see somebody entering a volume of tax returns and not appreciating kind of the strategy there. And I've had to have conversations with CPAs where we explain what's going on and how it's non-taxable. So I think that's something that's really important to look out for as well, to make sure that your CPA has the correct information and then that correct information is being reflected accurately on your tax return.
Yeah, good point. Let's touch on estate planning, just as we've launched Blue Chip Estate Planning. When I think about tying a bow on your family's estate plan and making sure that your orders or your affairs are in order, when's the best time to handle or address your estate plan? I'll answer the question. The best time is yesterday. If you haven't done this, if this isn't part of your planning, your current planning, or something that's been addressed, estate planning is critical. You want to really make sure that your estate is out of the hands of the state in the form of probate, if you were to pass away, and having the state come in and dictate who gets what assets. And so look at the benefits of a living trust and a living will, and making sure that deeds on your house are properly recorded, or if you need powers of attorney in the form of medical, durable powers of attorney. These are all really important. So from a timing perspective, we're bringing it up in January, but this is not a seasonal recommendation. This is a recommendation that if it hasn't been addressed, the best time to do it was yesterday. So,
and I think that's almost like a great New Year's resolution type item, right? And just things to get cleaned up.
And it's on our radar. And again, I think not to pat ourselves on the back, but as we've added services to Blue Chip, in order to elevate the client experience, it's front and center for us all the time. We're here on a regular basis with clients, drafting and executing financial plans. And what's part of a financial plan? Managing your portfolio. What's part of a financial plan? Managing your tax environment. What's part of a financial plan? Managing your estate plan. And so with these additional services here under one roof, under one umbrella, it makes it top of mind. And so again, I think that's a benefit of working with a firm like ours. The services are coordinated. They're not fragmented. We're not sending clients 5 miles down the road this way for tax and then 10 miles down the road that way for estate planning. So it's really nice. And I think it elevates, at the end of the day, it's one of our core values, elevates the client experience.
Yeah, well said. Are there any other buckets of items that we want to talk about today in terms of making the most out of the relationship that individuals have with wealth management firms?
I'll throw one last item out there. And again, we know our process. I can't speak for other advisory firms, but we have a process behind the scenes that's helping us reach out to clients on a regular basis. So no one gets left behind. But I would say to the listener, if there's something that's top of mind for you, or you have questions or planning concerns, feel free to reach out to your financial advisor. So this is really a two-way street. I would say the onus is on us to reach out to our clients and to make sure that we're staying in front of them. But I want to remind clients that if there's items that come up, reach out, because it's a two-way street. We want to make sure that it's a partnership with our clients, and we're working towards achieving a common goal together.
Yeah, I think one thing that's natural too that comes up, we talked a little bit pre-podcast on this, is cash flow changes, right? So individuals can get promotions, bonuses, maybe are higher than expected, lower than expected, or retirees might find they need a little bit more. There's an additional expense in this next year. They need some more money. So I think communicating cash flow changes, whether that's for the positive for savings or just results in higher distributions, that's something you want to communicate as well. And that ultimately ties back to the financial plan. But it's a great time to update the financial plan with some new data that we can ultimately reflect through the output of portfolio management and savings opportunities as well.
Nice.
So, what I'm taking from this is making the most of your relationship with a wealth management firm in the first quarter of 2025. Above all else, you have to engage. Communication, actively participating in the relationship.
Yeah, that's absolutely the truth. That's the cold, hard truth. And it's not always easy to do from the client side. We have a process on our side, but it's a collective effort across both parties.
Yeah. Okay. Well, thank you everyone for joining us today on another episode of Blue Chip Now. Check out our YouTube channel, Blue Chip FM. Look forward to speaking with you next time.